Good morning, everyone. It's 10 o'clock, so we'll go ahead and call the meeting to order. Item number 2 on the agenda is approve the minutes of the meeting of March 9th, 2017. Have a motion and a second. All in favor? Aye. All opposed? Motion carries. Item 3, we have ratify approvals. Item A is to approve the payroll for the month of March 2017. A motion and a second. All in favor? Aye. Motion carries. Item B is the action of the Secretary and Administrator in modifying the application due to a change in average final compensation and monthly pension amount. We have 14 cases. Second. Have a motion and a second on item B. All in favor? Aye. All opposed? Motion carries. Item C is to ratify the approval of the action of the Secretary and Administrator in modifying the application due to a change in monthly pension amount ineffective. Have motion and a second on item C. All in favor? Aye. All opposed? Motion carries. Item D is payment of claim to NCPERS for conference registration for Renee and Carla in the amount of $1,600.
Move it. Second.
Have motion and a second. All in favor? All opposed? Motion. Yes.
Renee, does this not cover my registration?
Yours was already.
Oh, okay. Thank you.
Yeah. We didn't tell you.
I see that here.
Okay, so we have a motion and a second on item D. All in favor? Aye. All opposed? Motion carries. Item E is assignment in the investment management agreement between the Oklahoma City Employee Retirement System and Intech Investment Management, LLC, dated August 14th, 2006. Have a motion and a second on item E. All in favor? Aye. All opposed? Motion carries. And item F is the payment of claims to Staples in the amount of $1.79. Any questions?
Missed one item, and it was $1.79 short.
Now that's due diligence. Do I have a motion on item F?
Second.
The motion is second on item F. All in favor? Aye. All opposed? Motion carries. Item 4 is to approve the claims docket. Have a motion and a second on item 4. All in favor? Aye. All opposed? Motion carries. Item 5 is to approve the following applications for service retirement. We have 7 cases. Have a motion and a second. All in favor? Aye. All opposed? Motion carries. Item 6 is to receive the report of death, authorize the payment of $5,000 death benefit, and authorize the Secretary to make necessary changes to conform on the following. We have 3 cases. Have a motion and a second on item 6. All in favor? Aye. All opposed? Motion carries. Item 7 is to receive the report of death, authorize the Secretary to make necessary changes to conform on the following. We have 3 cases.
Second.
Motion is second on item 7. All in favor? Aye. All opposed? Motion carries. Item 8 is to ratify approval of the following: to terminate vested rights and receive a lump sum distribution of his or her employee contribution account. 1 case.
Move item. Second.
Motion is second on item 8. All in favor? Aye. All opposed? Motion carries. Item 9 is to approve the following application for vested rights. We have 2 applications.
Second.
Have a motion is second on item 9. All in favor? All opposed? Motion carries. Item 10 is to approve the request of the following to terminate vested rights and commence drawing retirement benefit. 2 cases. Motion is second on item 10. All in favor? Aye. All opposed? Motion carries. Item 11 is to receive the report of death of employee while in active service, approve pension to the spouse. I have a motion and a second on item 11. All in favor? All opposed? Motion carries. Item 12 is items for individual consideration. Item A is a selection of Apollo Investment Fund 9 private equity. Jason?
Thank you, Mr. Chairman. This morning we have two recommendations for the board's consideration on one private equity fund and one opportunistic real estate fund. As you look at the ASAP, you'll see in the asset allocation you have a 5% target to private equity. You're at 4% currently. As you know, private equity works differently than other asset classes in that you have to make commitments or promises to fund partnerships that call down capital over time. The selection process of funds is a little bit different because these vehicles are not always available. They are born, if you will. They come to market, they raise capital, they close to new investors, and then they invest that over time. The same with opportunistic real estate vehicles. So it's a little bit different process that we go through. We are in an ongoing identification process, if you will, and Joe, my partner Joe, is going to describe that. So with me here today is Joe Nugent. He's a director at Asset Consulting Group. He oversees all of our private market research for private equity and private market real estate, and I'm going to let him walk through the presentation. I'll go over here and see what it's like.
Thanks to the board for the time. There should be a handout for everyone. It's this book that says Private Equity and Real Estate Program Review and Recommendations. I'll try and be brisk with my comments. Please stop me if you have any questions at all. As Jason mentioned, private equity is a little bit different than hiring a traditional asset manager, where if you hire a large cap manager and you fund them with $50 million, you give them the $50 million and then that's done. They invest the money and it stays invested until you ask them for the money back. With private equity, the process is different. As Jason said, it's like being born. Each one of these new funds comes around only infrequently. Typically every 3 or 4 years, an investment manager will raise a new pool of capital, and then they'll take those commitments from yourselves and other investors and identify investments over the course of 4 or 5 years and buy things, fix those things, and then ultimately sell them and return the capital to you. So the system started with the private equity program in 2009. There have been a number of commitments made to date, and this is a follow-on investment with a new manager, a new strategy for the system, but a complementary strategy to what you have already in place. A couple reminders about what our objective is with the private equity portfolio. It's a bit different than the rest of the portfolio. Oftentimes you think of your bond allocation as a place to get income for your portfolio, your equity, your large cap allocation, long-term growth. Private equity, really the objective is to drive high returns over long periods. So we want to be in the strategies that have the capability of driving higher returns than what are available in public market investments. So we try and identify those managers who are best positioned to make that objective. If you look at slide number 1, we've got a comparison of private equity returns to other public market returns, bonds, equities, non-U.S. equities, et cetera. And over long periods of time, and here we're measuring just 10 years, but the same is true for 15 years, 20 years, however long we wanted to go out, private equity has provided a premium of returns versus public markets, somewhere in the neighborhood of 200 or 300 basis points, so 2 or 3% per year on average. Private equity funds have outperformed public equity markets. So that's an important piece of your portfolio. It really helps to boost the returns. Slide 2, we talk about diversification and risk. Private equity can mean a lot of different things. Some people, when we think about private equity, are thinking about maybe venture capital, where you're funding businesses that are, just starting out and maybe not even proven yet. Well, that's just one flavor of private equity. There's many other things, too. There's leveraged buyouts, which is more along the lines of what we're going to talk about today with Apollo. There's distressed managers, managers that specialize in buying companies that are broken and then repairing them and making a profit out of that. So there's a whole wide spectrum of opportunities that private equity covers. When we think about a private equity portfolio for the system and for all of our clients, we want to make sure that we've got exposure to all of those different areas of the private equity market so that we don't expose ourselves to an outsized risk like happened in the late 1990s. You know, we had great results in the late 1990s in the tech sector, but then by 2000 that party was over, and if you had all of your assets in the tech sector, you felt the pain. So we want to make sure that we're spread across different sectors, different styles, and even different managers within the private equity portfolio. Slide 4 is something that's got a lot of numbers on it. It's something that we spend a lot of time on at Asset Consulting Group because we need to know we have a 5% target with the system's private equity portfolio. We need to know that we're going to get to that target and then maintain around that level of exposure. And the thing that we can control is the new commitment dollars that we put out. Once the system makes a commitment, the manager is the one who's responsible for investing it. So in order to control our target allocation, we make sure that we make regular commitments to new funds on an ongoing basis. This model that we're showing the results of on slide 4 is what we use to help pace those commitments, to determine how much is the appropriate amount to commit to each one of the new funds when they come out and when we make a recommendation. So in this case, we did the analysis of your existing portfolio. We took a look at future opportunities, other opportunities that are in the market, and then came up with a commitment pace, $7.5 million on average in new commitments. Will keep you right around your 5% target on a go-forward basis.
I think it's important to recognize this is looked at. So if you go out to 2020, making $7.5 million commitments per year, this is showing you're at about 6.4%. We're just looking at this saying we don't want the model to show that we be getting up around 10 or down around 0, but it's revisited regularly because things change. The actual commitments or actual experience change. Other parts of your portfolio behave differently. The other thing we do that's not shown here is stress test this. What happens if your portfolio doesn't grow or if it goes negative? You know you've made commitments, you can't pull those back. So if you have negative portfolio growth and private equity starts going up, you don't want it to go to 10% because your equities fell by 20%. And so that's also tested in this model.
So a good way to look at that is slide 7, which is a backwards look at the portfolio. How has the portfolio built up over time? And this program, once again, started in 2009. We started out with a broadly diversified fund-to-funds exposure that gave us that exposure across all the different strategies that we were talking about earlier, of all the different private equity periods, and then we continued to build that up. The commitments build on one another, so we've continued to make commitments through the year, and the value of those investments has continued to build over time as the investment managers invest the capital. Conversely, the dark blue bars is the amount of capital that the managers have actually realized investments and sent back to the system. So that balance of investment managers continuing to call and invest capital and then realizing the older investments and sending that money back is what we're constantly trying to balance to get to that 5% target allocation. Slides 8 and 9 I'll touch on briefly. 8 is the performance of the portfolio of the existing investments. So 4 prior investments, 2 fund-to-funds. Mesero Private Equity is a fund-to-fund strategy, so they're a manager that invests in underlying managers. So they would pick out different venture capital managers or different distressed managers or different LBO managers. Singular Guff is a distressed-focused strategy, so that's a manager that focuses specifically on opportunities that are created by distressed companies. We'll be talking about them on the real estate side as well. That's our second recommendation today.
Just on that, you'll note that the Singular Guff was done in 2009, so distressed is a little bit more tactical in terms of the opportunity set when you put money to work there. And putting money to work after the great financial crisis and distress was very attractive at very low prices. There was a lot of opportunities. That's not always the case in distressed.
Yeah, and in fact, that's not really the case right now. It's very difficult to find distressed opportunities because default rates are low. The economy has generally been very good for the last few years, which doesn't lead to opportunities for distressed opportunity managers. There will be some out there, but if we were to get into another distress cycle, we might want to consider a strategy like that again. So you see the two fund-of-funds managers, and then Warburg Pincus, manager that we started funding in 2012, two recent commitments there, 2012 and 2015. That's a very, think of them as a very growth-oriented manager. So they lean, their bias of investment style is growth equity, almost venture capital-like, but more growth equity style. Results, which are always very important, you can see on the far right-hand column, the net return to the system has been double digits since inception, about 12%. We compare those to what's available in the public markets on slide 9. As you can see, it's been a very good time in the public equity markets, so it's been a very difficult benchmark to beat in terms of private equity versus public equity. But we're looking in relatively short time frame here. We've got only about 5 years worth of history in terms of the comparison to the public markets versus the private equity portfolio.
I think that's a good point, Joe, because this is private equity is beneficial to long-term investors like pension plans because you have long-term liabilities and you have a long-term time horizon. You can invest in a patient asset class like this that takes a long time to realize returns. Even though you started this program in 2009 and we're 8 years into it, this is a very young, almost immature private equity program. You're in the early stages of this private equity program. If you look at the age of investments, a lot of these, what money that has gone into the ground has been over the last 4 or 5 years, so it's pretty early on.
Slide 10 is a view of the sort of major categories of private equity that you can invest in, from venture capital, buyout, to credit-like strategies, and where each of the managers in the portfolio fit across that spectrum. So Mesirow Private Equity covers a lot of space because they do a lot of different things. It's a fund of funds. Singular Guff, the distressed manager, is very focused on sort of one area of credit, distressed credit. Warburg Pincus, the existing manager, a very growthy manager, and then Apollo, the manager that we're recommending today, that manager is a very deep value, contrarian-oriented bias. So they're looking for businesses, sometimes distressed if the cycle turns that way, but always deep value. They're not counting on portfolio company growth. They're counting on how can we fix this company that's broken and make it more valuable. So the recommendation is $7.5 million to that particular fund. I'd like to spend 2 minutes maybe talking about the specific manager here and then open for additional questions on the private equity allocation. Apollo, information on Apollo and their history is on slides 15 and 16. So this is their 9th global private equity fund. So as we mentioned, each one of these funds is like a brand new investment vehicle. It is a brand new investment vehicle. So they've done this 8 times prior. We love firms that have a great operating history. It gives us a great amount of comfort around their ability to execute on the strategy that they're putting forward for this fund, and we have a lot of history to look at to say, are they going to be successful? What environments will they be successful in? And what will that translate to? Hopefully translate into us from a return standpoint. As I mentioned, this is their 9th fund. It's a global firm. Apollo's based in New York, but they have offices all over the world, and they invest all over the world. That's another attribute that we like about Apollo. Just as we build global portfolios on your public equity side, we like to have global portfolios on the private equity side. And this is a manager who has the capability to do that. The majority of their investments are going to be North America and Europe, but they do have the ability to go outside of those areas if they want. Very diversified in terms of the sectors that they play in. Like you would think of a large cap manager, there's 8 or 9 sectors that they specialize in, which will also give us breadth across not being exposed to one particular tech sector or something else like that. Principals of the firm have been investing together for more than 20 years. That's Leon Black, Josh Harris, and Mark Rowan. They're still very active in the investment process. specifically on this particular product from Apollo. This is their flagship fund. It's their main strategy. They are very actively involved in the way that this fund gets invested. Results, that's slide 16. There are two things that I think are important to point out here. Number one is consistency of their prior funds. There's a lot of numbers on this page, so let me orient your eyes maybe to a couple of columns. About the fourth to the last from the right, you'll see the Apollo net IRR column. So that's if you were an investor in each one of those funds, what was your net return? So some very good results, 37%, 11%, 9%, 44%, 9%, 26%, 13%. What's important about all those numbers? A, you see double-digit returns across a number of them. B, there's no fund that's produced a loss across all of their prior funds. Their worst performing fund in a bad year was a 9% fund. While we wouldn't call that what our objective is, we want double-digit returns for being in private equity, that's still a reasonable result for what was a bad time overall in the markets to invest. So we look at this track record and we say that's a very good track record. Compares very well to their peers. That's the far right columns in terms of how they compare first quartile, second quartile, third quartile. And they've never had a fund that's been a bottom performer.
Could you run us through just real quickly, just kind of on a layman's version of IRR and just how that's calculated and how that applies if it's net of our fees, when you look at the total return?
Sure. So IRR is basically taking all the cash flows of the back and forth between the managers. So when you fund capital, that's dollars going to the fund. When they send distributions back, that's dollars coming back. You take the value of all of those at the time period that they're made, the date that those cash flows are made, and then you solve for a percentage return based on that. So
Annualized.
Yeah, an annualized return based on those cash flows.
And ultimately, with our investments, once it's finalized, that really is that's the true calculation. Is that still an accurate accurate way to assess value if we're looking at our investments along the life, say it's 5 years in, is that still the right way to
Yeah, yes, although it's not as meaningful a number 5 years in.
until you get to the end of it?
Right. It's hard to tell the score in the middle until the game's over with private equity funds. But the other measure is the total value to paid in, and that's basically for every dollar you've invested, what have they done with that dollar? It's a cumulative return.
So does that get to the place where it's looking at market value as well, like the market value of the assets they hold?
Yes. So, but like for the early funds, that Fund 1 and 2, that 1.8 total value to paid in, that's saying for every dollar that was invested in, they turned that into $1.80. So that's realized because that fund is
100% realized, yes.
Is 100% paid out. For more recent vintages, just like on your reports, that total value to paid in is current carrying value plus distributions divided by what you've put in.
And that's a very good. There's two important measures. To your point, IRR is one important measure to see what sort of a percentage return did we get, but that money multiple is the second one as well. We need to see that they're able to turn a dollar into something much more meaningful than $1, $1.50, $2. That's another important factor.
And are these measures of the fund as a whole exclusive of the fees that we're paying in, or does that get incorporated into that calculation on the IRR?
We show these numbers net of all fees.
Okay. Thank you.
Because there's certainly, private equity is a more expensive asset class in terms of the management fees that are charged, and managers also get a performance fee. So we're interested in aligning our objectives. We want to make sure that the manager is incentivized to earn a performance fee, but we only want them to take that performance fee if they've earned and paid dollars back to us. So we look at those terms. We spend a lot of time talking about the terms of the fund to make sure that the alignment is there in terms of the manager wanting to drive net returns to us so that they can share in profits and we can share in profits.
And so if you look at the fees there at the bottom of page 15, when we're looking at their fees on that sharing, and is this one the one that has the after 8%?
Yes.
Okay. And it's an 8% return on?
Cumulative return on every dollar that we've put into the fund, we need to earn an 8% return back, annualized, before they share in profits. They share in 20% of the profits above that
After
8%.
that, okay. And is that similar to what we've done with other private equities, that you have a revenue share? And on most of them, because one of the things I've heard a lot recently is to talk about, do we move away from fees based on on committed capital and move to invested? And this looks like it's kind of a blended version of that partway through you really do move to invested capital. Is that something that's more common within the market that's changing?
Yes, there are changes happening in the market in terms of what the management fee base is. In this particular case, they've calculated it on committed capital in the investment years, and then later on it scales down to recognize that the dollars, the invested capital is going to come down as they realize investments over time.
So generally what that means is in the first few years of the fund, the investment years, when they're putting money to work, so year 0, birth through year 4 or 5, they're charging the fee on committed capital. After that point in time, then it goes to invested capital. And as invested capital starts going down with distributions, then your fees start going down.
Okay.
But the returns...
So we're going to be doing that. In the early years, you end up paying more. Like you said, it's more of a long-term view. Early years, you're paying more in the fees before you're really seeing the returns come in.
And that's why when you look at, you go back to your own investments on page 8, and you see Warburg Pincus has a negative 17% return. It's because really that's just fees. You're paying fees on committed capital of $10 million, and not a lot has been put to work. It's not write-downs. It's just fees and expenses early on. That's the J curve.
Right. Okay. Thank you.
Additional questions on the private equity recommendation, which is $7.5 million to Apollo Fund 9?
One more question, and I think I understand this from the standpoint of just practically how you get into these funds and the timing of it. But, on most of the other investment managers we come in, we'll bring a couple of different options, and then you do some analysis for us and help to go through that. In this case, we're looking at one. Is it just the practical issue of timing, that having something available at the time we're ready to get in is what drives that?
Sure. So from a process standpoint, because these funds have a limited offering period, they'll open and close very quickly. In the case of Apollo, they're talking about having one single closing, so there will only be one opportunity for investors to commit to the fund and participate in that fund.
But what we didn't see here that you brought, what we didn't see come here is you guys did the work before when you're narrowing this down, that you've reviewed that, and it just came to the point of this is the fund that you recommend for us.
Right.
But
It's not
Correct.
Number one, unlike large cap or small cap, there's not a universe today of 50 Apollo comparables to go out and say they're all available in the market right now. There may be, there's not 50 that are comparable to Apollo, but there are certainly hundreds of private equity funds that are available in any given year. And Joe and his team are looking at that pipeline. They're meeting with, you can give them numbers.
100 managers in a given year. And for different client portfolios who have different objectives, there are different recommendations. For this particular portfolio, what we're always looking for is best available manager. We always want to keep that top of mind. Best available manager that fits with the objectives of the portfolio. So as I would describe this portfolio, we're looking for a manager with ability to invest across a number of different strategies, complementary to what you already have in place, and where we have a high conviction level and their ability to drive strong returns.
The timing of how they come to market doesn't lend itself to, okay, let's bring 3 to compare side by side. Okay. And
Correct.
what you're comparing side by side to is multiple historical funds. So it's just not, it doesn't lend itself to that type of process.
Yeah, and our process from the standpoint of all private equity and all the things across all client accounts is we do many different things, and we're always trying to get the best fit. We meet with multiple managers. We take hundreds of meetings over the course of a given year, not just on funds where we have an existing client, but new fund strategies that we may want to recommend. we've actually been investors in Apollo, or clients have been investors in prior Apollo funds, and we've known them for many years, so we know they're coming to market. The timing is always a little bit hard to determine for sure, because they don't come to market until they decide it's time. So that's the pipeline we're always trying to line up.
The work that we do in underwriting these and evaluating them before we would come to you is significant. And I think you may recall that I said we would be here last month with this recommendation, because we knew Apollo was in the market. Joe and his guys had been meeting with them, but their legal documents, offering documents, they weren't issued until like 2 days before the last meeting, and that's a big part of the review for private equity funds. We can be comfortable with the team, their track record, and their process, but when you're committing to a 10-year vehicle, we want to make sure, and we're not doing a legal review so much as making sure that those terms are consistent with what the market suggests today. So these hurdle returns, 8% hurdle returns, those fee structures, other provisions like key man provisions, what happens if somebody leaves, all of those things. And so that require a lot of work goes into this before it comes to you.
I've just got one question. Just based on some quick math, I guess this allocation will put us right at our 5% target allocation.
Well, go ahead.
Yeah, so the $7.5 million
Yeah.
will not be funded all up front. That'll take 4 or
Right,
5 years.
right, exactly.
So that's going to continue to build up, and some of the older funds, Mesereau and Singular Gulf, are continuing to wind down. So this allocation will continue to push you toward that 5%, and that those older funds will continue to pull you down away from that. So that's why we have that, try and get a consistent pace of commit of $7.5 million per year going forward, and that should balance out your commitments to around that 5% target. We're always trying to work toward that. We know we'll be a little above or a little below, because once we make the commitment, it's really the manager's discretion as to when they find investments and actually invest those dollars.
Okay.
So
Thank
this
you.
won't end. We'll continue
Right.
making commitments, but we'll want to review this again in a year or so, probably. And one thing I do want to point out, because we, as Joe mentioned, we started off with a very diversified fund-to-funds approach. Based on your size, a couple of years ago, we said we think we can disintermediate the fund-to-funds and that extra layer of fees and some of that over-diversification without giving up diversification benefits of a number of holdings. So what we're trying to do with a Warburg Pincus and Apollo, these are very large global players, bellwether names in the private equity industry, but they're both investing in a significant number of underlying companies.
Right. Apollo would hold maybe 50 underlying companies. Warburg Pincus slightly more, maybe 60 in each one of the
Still
funds.
have significant diversification, but we're cutting out that extra layer of fees. At some point, as the program grows, on page 10, you see there are still some holes. I mean, some smaller buyout. There may be some opportunities as the fund grows, the overall fund grows, and the program grows to do some other things in some more niche areas. But we think these two, Warburg Pincus and Apollo, make a really good combination of really growth and value in the private equity space. So you want to take that recommendation first. So our recommendation would be to make a $7.5 million commitment to Apollo Fund 9, subject to legal review and documentation.
So I make a motion that we follow the investment consultant's advice on the investment or the commitment of $7.5 million to Apollo Fund 11.
9.
Okay, we have a motion and a second on item 12A. All in favor? Aye. All opposed? Motion carries. Item 12B is the selection of Singular Gulf Distressed Real Estate Opportunities Fund 2B.
Great. Thanks again. We're going to shift gears and talk about the real estate allocation. If you look at your ASAP, there's two different real estate allocations, a core allocation and an opportunistic allocation. The difference between the two real estate allocations being a core allocation is really a high-quality, long-term hold, biased, income-focused real estate ownership. And opportunistic means all the other things you can do in real estate, development, lease-up, construction, all sorts of things where you can potentially earn higher returns. So right now the system is slightly overweight on the core side and slightly underweight on the opportunistic side. Opportunistic real estate operates much like private equity. Funds are raised, managers raise a fund around a strategy, then they close and invest that money over multiple years, and as they realize the underlying assets, sell those buildings, they send the money back to the system. The trade-off for that additional layer of complexity and illiquidity is higher expected returns. So the opportunistic allocation within the real estate portfolio is really a performance driver. We're trying to drive incremental returns above and beyond what's available in the steadier core real estate space. We included some overview material on the real estate sector overall. That begins on slide 19. Something like the neighborhood of $47 trillion worth of real estate across the globe. About 13 trillion of that is actually in the United States, so that counts this building right here and my house and buildings in New York City, high rises, everything. $13 trillion worth. Of that, you see the tall bar chart there, about $1.4 trillion is in REITs, which you may be familiar with. Those are publicly traded real estate investment trusts. So they're bought and sold on the stock market. The underlying assets are real estate, but they trade like stocks. You have exposure to REITs because some of your public equity managers buy and sell REITs on an everyday basis. What we're talking about is that purple shaded area, which is private real estate in the United States. That real estate is similar real estate in many cases to the stuff that's in REITs, but we don't like the volatility of the REIT market. It gets traded on a daily basis just like stocks. In private real estate, there's none of that daily pressure to buy or sell. Specifically in the core space, core real estate space, those are generally longer-term holds because of the high quality of those assets. So there's no reason for those to be traded in and out of on a daily basis. But the universe is extremely large. If you compare the pie chart, the real estate market's about $13 trillion. We compare that to the bond market and the equity markets, which the portfolio is also invested in. The real estate market is a significant part of the investable universe. Slides 20 and 21, lots and lots of numbers, but I'm going to skip all that and go to the punchline. If you look at slide 21, it really explains why we put a real estate allocation in place in a diversified investment portfolio and what that does for your portfolio. So the top left circle is what we would call a traditional portfolio, 60% stocks, 40% bonds. Over the last 15 years, that portfolio would have gotten you a 5.79% return. That's the circle at the very top. By adding real estate to the portfolio, both core and non-core, if you follow the arrow down, those portfolios had higher returns, and they also had lower risk as measured by standard deviation or volatility, which is one measure of risk. So what we're trying to accomplish by adding real estate into the portfolio is diversification away from stocks and bonds and the ability to increase the efficiency of the portfolio because real estate doesn't act like stocks and bonds. It has its own separate drivers of return. Slide forward to slide 23. There's a continuum of risk in real estate, as I mentioned. Core real estate, this is your current portfolio manager, Morgan Stanley Prime Property Fund. That's a lower risk return real estate strategy. They focus on buying really high quality buildings in great locations that have almost 100% leased. So these buildings are full, and they throw off operating income. They take the lease payments, subtract what it costs to run the building, and that's the profit. Those buildings tend to hold their value because they're in such great locations. So think of buildings in the middle of Manhattan or the middle of Chicago or the middle of Los Angeles, where there's almost always going to be demand from people who want to rent out that space. If we move up the value curve, TA is a manager that you have in your portfolio as well. We call them a value add manager. They take a little bit more risk. So what they do is they may not buy an empty building, but they might buy a building that is 50% full. So that may be marginally profitable or even slightly unprofitable when they buy the asset, but then they want to lease up the remaining space, take it from 50% occupied to 80% occupied. Then that building will create cash flow, and then that building creates profits for the investors. So they're a little bit farther out on the risk spectrum, but not a whole lot. The manager we're going to talk about today would be the first really opportunistic, truly opportunistic manager in the portfolio. Singular Guff, who we mentioned earlier as a distressed opportunity manager, that's their focus of their firm. Their investment strategies all are focused on distressed opportunities. This is a strategy that they started in 2009. They brought in a new team. We've had exposure in other client accounts back to their very first real estate fund, and this is a continuation of that strategy. So this particular strategy is a bit farther out on the risk curve. They'll be taking significant lease-up risk, or they'll be taking a little bit of construction risk, and that's appropriate for a small piece of the portfolio so that we can help drive those incremental returns that are available for taking on that additional risk. Talk a little bit about on 24 and 25 about real estate and what the risks are, all the individual risks that you can take within real estate, and then maybe most importantly on 25 I wanted to touch on, so what's the value proposition of real estate? What are we trying to accomplish, and how does it compare to what's going on in the broader markets? So what we're comparing here is the cap rate for real estate assets broadly across the United States. Cap rate is just a measure of really net operating income divided by property value, so that's a percentage, versus what you can get.
Think of it as a dividend yield for real estate.
So that's about 6.5% for investing in real estate, versus the 10-year Treasury, which is about 2.5%. So there's a premium for investing in real estate, which is appropriate. We want to be compensated for doing something that is outside of traditional core bonds or traditional equities. And we want to make sure that from a valuation perspective, we're stepping into a place that still has value. For example, the gray bar on this chart, or the gray shading area, in 2006 and 2007, that spread between what you were being paid to buy a treasury and what you were being paid to own real estate was very low. It was less than 2%. So you weren't being compensated very much in that time frame for owning real estate. That spread has widened out. Now it's right near its historical average. It's about 4%. So versus a 10-year Treasury, you get about 400 basis points more potential return for owning real estate as opposed to owning that Treasury. That's another reason why we like real estate in a portfolio, and what the market for real estate looks like right now from a pricing perspective. Slide 26, you'll recognize from the private equity discussion earlier, we do the same process when it comes to figuring out how much capital is appropriate to commit to new funds. We have a model. We take into consideration what your prior commitments have looked like, and then we project what's the appropriate rate to get to your target allocation. So in that case, we've done all that work. The result is we think a $10 million commitment to the new Singular Guff Fund would be appropriate to help move you toward your opportunistic real estate target. Once again, I'll take 2 minutes on the specific manager. This is a manager that you have in your portfolio already, but in a different strategy. The strategy that you have is in the private equity portfolio. It is Singular Guff's Distressed Opportunity Fund strategy. That strategy was focused on corporate credit more than anything else. So they were buying, credit, mostly defaulted credit from corporations across the spectrum. The Distressed Real Estate Fund is focused on distressed real estate. So they brought in a team beginning in 2009. They identified, if you wind the clock back and think about the market environment in 2008, 2009, in many ways we had a real estate-led recession. Real estate was the first thing to go down. Singular Guff having the ethos of looking for distress and then trying to find opportunity in that said what we need is skill set around the real estate opportunity. So they went out and hired a team. Jim Coral is the head of that team. He prior spent, I don't know if you've heard of Cohen & Steers or not, they're a big REIT firm. He was the former CIO of Cohen & Steers. They brought him in, another investment professional named Tony Corriggio. Those are the two managers that run this strategy. They've done an excellent job so far in their prior funds. This is an extension of that strategy that they've been running since 2009, a new fund. It's a little bit different in terms of it's a hybrid strategy. It's not a fund of funds, and it's not a direct fund. Singular Guff generally runs fund of funds. This one is going to balance between the two. So they find managers that they've invested with on a funds basis and then seek to invest in individual assets alongside that manager and create a portfolio of the best assets out of individual funds. It's a much more efficient from a fee structure standpoint than a regular fund of funds portfolio because, once again, you're eliminating a layer of fees when you go direct into individual assets. Still will have reasonable diversification. This will be, a portfolio of probably 20 to 25 individual assets and perhaps a couple funds, but mostly individual assets. Diversified across the United States and Europe. This is not a fund that we would expect to do a significant amount of investment outside of those two markets. Diversified in terms of their strategy, they'll do all different property types, whereas your core manager will really stick to main property types, office, industrial, retail, multifamily in the United States. Other managers, or this manager will invest across things like self-storage or senior housing or other property types where they can develop higher returns. Results are on slide 32. The vehicle that you're invested in previously is called DOF3. It's about in the middle of the page. So you've experienced those results from their prior fund. Their prior real estate funds are the ones, the last three columns, DREOF, which stands for Distressed Real Estate Opportunity Funds. So they have three prior vehicles there, DREOF 1, 2, and 2A. We're recommending a commitment here to Fund 2B.
These are closed.
Correct. Those are all prior vehicles that are all closed and invested, in many cases, fully realized. Like DOF1 is a fully realized portfolio at this point. DOF2 nearing full realization.
So this would be complementary to the Morgan Stanley core real estate position. You have a target allocation of 4% to opportunistic real estate. You've just got a small piece there right now with TA. This would be adding to that.
It's the pleasure of the board.
Can you explain the fee structure on this one? It had an extra component of layering of funds.
So this is a hybrid strategy. They have a separate fee schedule, and we'll go to slide 31, which shows the fees. So they charge 100 basis points on net invested capital, which is attractive versus committed capital.
So different. This is exact opposite of what we talked about on the private equity side.
Mm-hmm. And much more attractive, and this is to your point about is the industry moving in this direction. This is one of the firms that has moved toward net invested capital as opposed to committed, which is much more efficient for us. And then on the performance fee side, there is a different incentive fee whether they do a direct investment or a fund investment. So for direct investments, they get 15% of the profits, but only after they have achieved that 8% return. Just like in the private equity portfolio, they have to achieve an 8% return back to investors before they're allowed to share in any of the profits. So they get 15% if they do a direct investment, and only 5% if they do a fund investment. That helps align us a little bit better. From a fund investment standpoint, they expect to do maybe 1 or 2, but the threshold for work that they have to do for a fund investment is lower. Therefore, they get a lower percentage of the profits for doing what is essentially less work.
Just the pace relative to a private equity fund, this fund will put money to work much quicker than so that's part of the fee structure.
Yes, this fund is expected to deploy the majority of its capital in probably 2 years. depends on the market environment, but that's the target that they think they can do right now, as opposed to Apollo, which will take more like 5 years to invest the capital.
Any further questions? Hearing none, we'll entertain a motion.
I'll move approval of the recommendation of the consultant on $10 million investment or commitment to the Singular Gulf Distressed Real Estate Opportunities Fund 2B. Got it.
Having a motion and a second on item 12B. All in favor? Aye. All opposed? Motion carries. Item 13, investment consultant report.
Thank the board for their time, and Jason is going to do the consultant.
Okay, thank you. I'll be brief. You have the monthly ASAP in front of you. March was a okay month. You can see your 1-year return now at the top of page 2, up 11%. Probably came down a little from what the 1 year was at the end of February, because you're taking off another good month from into last year. It wasn't that March was bad, it was just about flat. But the relative returns are, the spread is starting to grow a bit. The relative to the policy index, you're about 11 basis points ahead. Really, large cap has been a bit more challenging area, even though you're up 16%. The active component is held you back a little bit. Small cap is in line roughly with the index. Long short has done well. That K2 strategy up about 11%. Much of this has been coming since July. The turn of the markets toward more active management really started benefiting about July of last year. The fixed income has done very well. International is a little bit of a sore spot on a trailing 1 year basis. We talked about this a bit, I think, at the last meeting. This is primarily Lazard, your international value manager. They had a significant underweight to financials and materials, European financials and materials. And those sectors of the market really took off along with the U.S. market, and they believe that there's not as much value or reason for European financials to move like U.S. banks did. So they were underweight there. That's turned around a bit, and they've done a bit better more recently. The fixed income composite has done very well as rates have begun to rise. Your strategies, the non-U.S. or global bonds with Brandywine, Core Plus with Western Asset Management, and then the hedge fund portfolio with PAMCO have all been very additive. And your fixed income composite up almost 3.6% relative to U.S. investment grade bonds, which are essentially flat. There is one thing. I want to talk about PAMCO for a second. I think we talked about them a couple months ago as they had entered into a merger with another firm that really hasn't created any issues or concerns. But we got a call from them last week. You're in what they call a master feeder fund structure. So the strategy you're in, which is their conservative multi-strategy hedge fund of funds, there's a master vehicle, and then there's multiple feeder funds for different types of investors, U.S., tax-exempt, taxable, non-U.S., that feed into the master fund. The vehicle that you're in has about 180 million in investor assets, and I want to say it's about 9 or 10 different investors. Overall, the master fund is much larger and many more investors. There's 2 investors that indicated their intent to redeem from that feeder fund, that to the tune of about $50 million, so bringing the assets in that particular sleeve down. They had contacted us a week ago, I guess a week and a half ago, indicating that they were going to seek consent from all investors to amend the operating agreement to what they call side pocket certain illiquid investments, which would be a benefit to investors not getting out, because there are certain positions in that portfolio that are not, they're illiquid. They couldn't sell them, and they didn't want a redeeming investor to take liquidity to benefit to the detriment of existing investors. So that they indicated to us that they were going to be sending something out to investors immediately. This week, they came back and said, we've decided not to do that. We've worked with the redeeming investors and simply side-pocketed their investments. So they set aside, if they were asking to get $10 out, they gave them $9.50, and they held that 50 cents back. It's about 5% of the assets. So there's no immediate issue, but that being said, we want to spend a little bit more time on this and understanding with that if there's going to be issues with redemptions in this smaller feeder vehicle, perhaps there's some other options that we should be looking at. So I'm really just wanting to bring this to your attention today. We'll come back probably in the next couple of months and drill down on this a little bit further, but I wanted to bring it to your attention because they intended to send some action items out. So we'll be back to talk about that in more detail and potential other options. So all in all, portfolio is doing well. The exception of that one particular manager issue, no manager issues of note. Any questions?
What was the incentive for the other investors to want to get out? Do you know?
No, they just made an investment decision that they wanted to get out of the strategy. Not really sure what it was. It did not. It did not have to do with the merger of the firms. It's not a qualitative issue. Okay.
Okay, any questions for Jason on the ASAP?
Thank you.
Thank you, sir. Item number 14 is comments from board, staff, and citizens. Hearing none, we are adjourned at 10:57. Thank you.